Hey folks, and welcome to the Pipnotic Symposium for the 12th of August 2020. Today we're going to talk about the histogram and what the lines mean. We've gone over this in the histogram video on the Welcome to Pipnotic page. So if you haven't watched that, please go back and watch that. But for the sake of repetition, I'm just going to go over the histogram one more time. I'm just going to spend a couple of minutes on this video today just to explain what these lines do. Okay, first of all, what is the histogram and what does it do? Well, the histogram is, unlike the GFX, it focuses on one currency pair. Okay, it represents two currencies, which we can see here. The red line represents the British pound, the green line represents the American dollar. And the gray histogram, this is the difference between the two. So if the histogram is above the zero line, then this currency pair should be moving higher. If it's below, it should be moving lower. Okay, so the histogram is then used as input to a very simple quantitative model, which results in three lines that you can see here on the rightmost edge of the chart. Okay, we have a red line, which is above the zero line. We have the green line, which is below the zero line. Then we have the orange line, which can be above or below. We'll start off with the red line. The red line is simply showing us extreme deviations from a mean, and the mean is calculated using a window of histogram data. So this is going to constantly be changing. This is going to be moving higher and this is going to be moving lower based on histogram data. Okay, and so the idea is that when the histogram pokes into the red line, then price is probably going to start to move lower from here. And if we look at last time price did that, it's going to mark off here. So I was going to mark off the peak, which is right there, and then we're going to mark off the low, sorry, the high here. It happened just here. So the crosshairs marks exactly where the histogram poked above this positive deviation. Okay, so this is an extreme positive deviation based on this moving window of data, and so when price comes up to this level, we can expect price to move lower. And this is exactly what happened in this example. Price came up to this area of supply at the same time that the histogram poked into this I suppose you can call it like a positive variance. And when this happened, the strength reverted to the mean. The price of this security started to move lower. And the same applies for negative deviations from the mean, where we have this green line. And the reason this is green is because this is buy signals, and the reason this is red is because this is sell signals. Okay, so when the histogram moves down into this region or close to this green line, well, it's telling us the price is very likely going to move back in towards the mean. And if this happens at an area of demand that you can see, for example, down here or wherever else you can see one on a price chart, well, then it's a good time to buy. Okay, and this is just focusing on a currency strength. And when you combine that with the software that focuses on supply and demand, when these two overlap, then you have a very high odds trade setup. Then you have the orange line, and this is simply a mean. So this is telling us the average. So the average of all the histogram data for the number of periods specified in the configuration of the histogram is telling us that we have a bias to the upside. So that means that we have a long trend for the British pound American dollar based on the histogram data that we can see here. Okay, and this can change, of course. If you change the settings here, we have, for example, mean periods. If we set this to 500, well, then we're going to be looking at a lot more data, so this will probably change the location of all of these lines. You can see that the mean popped down a little bit more, and that's because that the further we went back, we were able to identify more negative histogram data, and this caused the mean for this British pound American dollar cross to move closer to the zero line, which means that we were historically more negative the British pound and more positive the American dollar, and this is changing. But you can also go very quickly. So let's say that we want to focus on the most recent 100 periods, and you'll see that things change. You can see that, wow, this is very positive. Okay, you can see that we have a very positive mean, which is telling us that if we go 100 periods back, so we're going to start right here, we're going to go 100 periods, which is about right here. I mean, you can see that this is very positive. Okay, this is a very positive histogram. Okay, you can see that the histogram is actually only positive. So the average of all the histogram data calculated exponentially is telling us that we have an upward trend, which we very clearly did. Okay, and so what I like to do is I like to focus on a little bit more data, so we have a more profound a window of data, and use this data to calculate these values. Okay, so just to wrap up, we have two currency strengths. We have the British pound and the American dollar when attached to the British pound American dollar chart. The histogram is the difference between the two, and the histogram is input into the quantitative model that results in these three lines. The red line at the top we should consider to sell this security once the histogram moves up into this red line. We should consider to buy it once the histogram moves into the green line, and the orange line is simply telling us the trend for the look back for the histogram data that the indicator has been told to focus on. Alright, I'll leave it at that. Thanks for watching. If you have any questions, please post them in the video below.